Josh, the Bank of America Global Fund Manager Survey calls sentiment at a Goldilocks bull level. They say the trade war and recession fears have abated. The cash levels have dropped to 4.2%, was 4.8 in April. Maybe there's a little more buy-in to this story, feeling like it's gotten a little better.
The thing to understand about the Global Portfolio Survey is that these are people whose livelihoods depend on them not missing out on massive rallies. So it's okay to have more cash when the president of the United States lifts up a piece of cardboard and says we're going to tariff the rest of the world 100% or whatever the number is on their goods. But once that piece of cardboard comes down and the real numbers start to surface, you can't just sit there and be like, no, actually, I think he was serious, and we're going to wait until the actual tariff news. Once the market figures out, hey, this is not going to be a worst case scenario. This is not going to wipe out 2 quarters worth of earnings. This is not going to crush the U.S. consumer, which is the most important engine of global growth. Then you have to decide, okay, maybe I don't want to be 70% cash. maybe I want to be 30% cash, and I'll find some stuff to buy. So that's exactly what's playing out. In the end, global portfolio managers are portfolio managers professionally, and if they sit completely in cash, completely risk off, and the market tells them they're wrong, the clock is ticking. They've got to ratchet up. So I don't look at them as a contrarian signal. I don't worry too much about this. I'm not one of these people who sees other people being bullish and instinctively has this knee-jerk reaction where it's like, well, that's it, time to take profits, everyone else is long. I just don't look at it that way. The way that I look at it, the stocks that matter are delivering. Magnificent Seven stocks are part of the formula that saved this market from a full-blown bear market when they reported earnings in late April and early May. 27.7% growth for that group. That's versus 9.4% growth for the rest of the S&P 500. And most importantly of that group is what NVIDIA did. NVIDIA is 26% of the S&P 500's total return year-to-date, stock price. And it'll be about 17% of this year's earnings growth. If you understand that the AI story and the U.S. consumer are the only things that matter, you could stop wasting your time reading a lot of other data and focusing on a lot of other reports. And those two things, to Stephanie's point, the consumer is fine and the Mag 7 AI theme is intact. If I told you nothing else, that would be enough to understand why we're on the verge of a new record high.